This is everything you need to know before you invest in stocks in 2026. A stock is also known as a share, and a share is part ownership of a company. A company issues shares through the Nairobi Securities Exchange, and as an investor, you buy part of the shares, right? So when you buy, let's say, 100 shares out of 1,000, you own a tenth of the company. Yeah. So how you earn from shares? You earn in two ways: through capital gains and through dividends. Through capital gains, for example, if you buy shares from Kenya Power Limited Company worth 30 shillings, this is just an example per share. And then after whichever period of time you want to sell your shares, and you sell it at 40 shillings each share, assuming you bought 100 shares, that is, you're selling it at 4,000 and you bought it at 3,000, right? Simple mathematics. That means you have a capital gain of 1,000 shillings within that period of time. Remember, this is passive income. You've not done anything, you just bought the shares and held it, and then at the end of the period you sell it and you get your capital gain. Number two way of earning from shares is through dividends. Most of the companies listed under the NSE issue dividends. There are two types of dividends, which is interim dividends and final dividends. Mostly it is around a shilling per share. If you own 1 million shares, you will get 1 million shillings in a year. So that's how you will earn from your dividends. Let's talk about the advantages of investing in stocks. Number one is that when you buy a share or a stock, you buy ownership into a company. So you are basically an owner of a company, right? Number two is that stocks offer high return compared to other investments. Number three is that stocks are highly liquid, so you are able to liquidate your stocks anytime. Assuming you want to sell, you need some money, you just go to the platform and sell, and you will find a potential buyer, and then that way you get your money back. On the disadvantages, number one is that stocks are highly risked, and this means that you can easily lose your money. Number two is that there's no guarantee of returns. This is not like a fixed return thing. You just buy stocks and hope that the price will go up. So if it doesn't, there's no guarantee. You'll possibly lose all your money. Number three is the volatility of the market. Stocks go up and down very quickly. So that volatility can make someone make uninformed decisions out of tensing or out of hype or greed, and make a big mistake which may lead to losses. The final takeaway from investing in stocks in 2026 is that stocks are a powerful way of building wealth, but they work best if you invest long term. Look at 3 to 5 years, not tomorrow or next week. You start small with any amount. It doesn't have to be millions. You diversify into different sectors. You stay disciplined and focus on your goal. And lastly, you avoid hype or tension, because that will make you make a rash decisions that might lead to losses. Other than that, I wish you a happy investing and enjoy building wealth.